When you invest, it's always tempting to try and boost your returns. And of course you can do that with leveraged ETFs. You can even make money in falling markets by having an inverse ETF. But this is a kind of Mephistophelian pact. It comes with its own drawbacks. Now, to look at what those drawbacks are, but also to see how these leveraged funds work and why they might not quite match your long-term return goals, let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. If you look for leveraged ETFs on Just ETF, you'll find it at the bottom of the menu on the left-hand side. But if you click on that, you get this disclaimer. It says that short and leveraged ETFs have been developed for short-term trading and therefore are not suitable for long-term investors, and that if you hold these ETFs for longer than one day, the expected and actual return can vary significantly. If you click on Confirm, you see this rather small list of funds. They tend to focus on large-cap developed market indices, such as the FTSE 100 and the DAX. And something that really jumps out is the very high expense ratios. And that's presumably because these things use derivatives embedded inside them in order to achieve that leverage. Now, these leveraged funds either let you match the daily leveraged index returns, or if you choose not to have leverage, you can match long-term index returns. But as we'll see in a moment, you can't do both. In other words, you can't match the long-term leverage return of an index. You can only match the leveraged daily return. To see why, consider two really extreme days. Let's say we're tracking an index where on day 1 the index falls by -10%. Then on day 2 the index rises by 10%. If we were to invest £100, after day 1 it would fall to just £90. And after day 2, because of the effects of compounding, it wouldn't rise back to 100, it would only rise to 99. Now remember, the job of the leveraged fund is only to match the daily return, and I've shown an example here where it does exactly that. So on day 1, the return of the leveraged fund is -20%, which is 2 times the return of the index. And on day 2, the return is +20%, which is 2 times the day 2 index return. If we were to invest £100 in that fund, after day 1 it would fall to £80, and after day 2 it would rise to just £96. And notice that's £3 less than if you'd invested in the index. So although the leverage fund has done its job perfectly, which is to match 2 times the daily index returns, over the longer period of 2 days, it's failed to match the index. And if we look at a 3 times leveraged fund, the discrepancy after 2 days is even larger. So during periods of volatility, when you get very large up and down moves, and for funds with the biggest leverage, you'd expect to see the biggest discrepancy between the long-term returns and the returns of the underlying index which is being levered. So during periods of high volatility, these deviations would get even larger, and they'd be biggest for the 3 times leveraged fund. Just to show what those daily leverage returns look like, I've plotted the daily returns of the S&P 500 on the x-axis. So this is a plus 10% return, and this is a minus 10% return. And I plotted that versus the returns on a very large and very old SPDR ETF. And you can see that it does track the returns 1 for 1. When the S&P 500 goes up by 5%, so does SPDR. And when the S&P falls by 5%, so does SPDR. If we add the Direxion Daily S&P 500 Bear 3 times ETF, whose returns are minus 3 times that of the S&P 500, you can see that that also does a good job of matching minus 3 times the S&P 500 return. So when the S&P fell by 3%, the minus 3 times fund rose by 9%. And when the S&P rose by 3%, the minus 3 times fund fell by 9%. But if we look at the cumulative returns for those funds over a long period from 2008 to 2019, which is about 11 years, you can see the SPDR fund did an excellent job of keeping track of the S&P 500. Its return was 11.1% and the S&P 500 was 11.2%. But the minus 3 times daily fund is far from minus 33%. Instead, it's fallen by minus 44%. The exact amount by which it diverges depends on the volatility during that period, but also on the leverage of the fund. And these are what the cumulative returns of those 3 funds look like, with the S&P 500 at the top, spider in green in the middle, which matches all the falls and rises of the S&P very accurately, and the -3 times fund is falling dramatically. And that's one reason why you wouldn't want to hold a leveraged inverse fund for a long period of time. Just as equity markets tend to drift upwards, inverse leverage equity funds tend to fall quite dramatically over time. And that effect is cumulative. So if you're going to take a short position, you're assuming that the index is going to fall over a fairly short time period. Otherwise, you're going to get hurt by the upward drift of the S&P 500. Direxion offers two versions of that fund. A bull version, which is long the S&P 500 and gives 3 times the daily returns, and a bear version, which is -3 times the S&P 500 return on a daily basis. But you can see that the expense ratio is extremely high, over 1%. That's almost 20 times what you'd pay for an S&P 500 tracker. And Direxion reiterates the point that these funds only match the daily return of the S&P 500. They shouldn't be expected to provide 3 times or -3 times the return of the benchmark for periods greater than a day. So what's a typical use of these leveraged ETFs? Typically they'd be used for a short-term bet. And I use the word bet deliberately because it is a gamble. It assumes that you can predict both the direction and the timing of moves in markets, which typically we're very bad at. But unlike derivatives, this is a product that you can put into some ISAs and SIPs, although I'd be very careful about doing that. And if you are going to use them, have a very small allocation and don't hold on to it for a very long period of time. The point about being able to time markets is a very important one. A company called Delbar does a periodic analysis of investor behavior. They looked at the average return of mutual fund investors compared to just the S&P 500, and they found that the average investor has always lagged the overall market. And the difference isn't a small one. The average investor earned half what they would have done if they'd have just bought and held the S&P 500. So by tinkering and moving in and out of their funds and trying to time the market, they reduced their return from 8.2% to 4.7%. So it would pay for all of us to be a little bit humble and to admit that we probably can't time markets. As I say, you can hold some of these leveraged ETFs inside a SIP and an ISA. So here's one issued by Boost, which is a 3 times leveraged daily FTSE 100 fund. And you can see you can put it into an individual savings account and a lifetime ISA and a self-invested personal pension. If we look at the returns of that Boost 2 times fund and the Boost 3 times fund, it looks as if it should be worthwhile. For this period since 2013, the return on the FTSE 100 has been rather poor compared to other global markets. And the 2 times leveraged Boost ETF has had a cumulative return of just under 7% versus about 1.6% for the FTSE 100. And the 3 times fund has had a return of 8.2% over that period. But it's usually a good idea not to just think about return. You should also think about the risk that you took to generate that return. And that's what we can see on this risk-return plot. Ideally, we'd like products which have a low risk and generate a high return. And for comparison, I've included the life strategy funds. This is the 20% equity fund, which has the lowest risk and lowest return, up to the Life Strategy 100% equity fund, which is a global pure equity fund. And we can see that the FTSE 100 has a risk which is greater than Life Strategy 100, but a return which is much lower than even the Life Strategy 20% fund. And while the 2 times leverage fund has a much greater volatility, a greater risk, its return is still well below the Life Strategy 60% fund. And even the 3 times leverage fund, which has an even higher risk, is still roughly comparable with Life Strategy 60. So while leverage definitely increases the risk of your portfolio, it doesn't necessarily increase the return. For the vast majority of people, it's best to simply have a diversified, low-cost portfolio which matches your risk appetite, which is how much risk you can stomach, and your risk capacity, which is how much risk you can afford. So leveraged ETFs are not the holy grail of investing, as some of the marketing material might lead you to believe. They certainly boost your risk, they certainly boost your daily returns, but they may not match your long-term return goals, particularly during periods of volatility. So if you found that video useful, please consider supporting us on Patreon. We rely completely on you for support. Plus you get to join our community and you get access to all of our backlog of previous calls and new calls on Sunday evening where we can talk about any question you like. Just click on the button above to find us on Patreon and see what benefits you get. And as always, thank you for listening.